In this video we are going to talk about 10 ways rich people make money with debt. So before starting this video, please like this video and subscribe to our channel for future updates. Many people are terrified of the word debt. There are a plethora of television shows, books, and periodicals dedicated to helping individuals get out of debt. While debt can be viewed as a bad factor, it can also be beneficial when used correctly. The most common way to use debt to invest favorably is to employ leverage to raise your returns exponentially. What precisely is leverage? Using borrowed funds to boost your return on investment is known as leverage. Leverage can help you achieve returns you never thought imaginable, but at the cost of a higher danger of losing your money. Here are ways that debt can make you richer through leverage. Number 10. Investing on the margin. Investing on margin allows you to acquire more shares at a lower price than you have available cash. For example, if you have $50,000 in a standard brokerage account, you could open a margin account to leverage your investment. A margin account permits you to put up a maximum of 50% of the stock's purchasing price. You would have $50,000 in cash and your broker would loan you an additional $50,000. Your $50,000 investment provides you with $100,000 in purchasing power. You could invest $100,000 in shares with this money. You can pay back the loan and pocket the profit if the stock price rises. The disadvantage is that if your account's equity falls below a specific level, your brokerage firm may issue a margin call. If you don't have enough money to make your margin call, your broker can liquidate your entire stock position, leaving you with losses. Number 9. ETFs with a high leverage. ETFs that are leveraged allow investors and traders to increase their returns by going long or short on a specific index. Leveraged ETFs, such as those offered by ProShares, allow investors to increase their returns and losses by 200 to 300%. You can invest in specific indices, bonds, commodities, or sectors using these funds. The huge profit potential of leveraged ETFs makes them appealing. With leveraged ETFs, you can reach returns that other investors only dream about during market booms. The difficulty is that leveraged ETFs can work against you in the same way they can work for you. Leveraged ETFs can exacerbate losses by wiping out your entire investment in a few days unless you are an expert at trading in and out of these products. Number 8. Hedge funds. Hedge funds are among the most heaviest leverage users. They are well known for exploiting leverage to generate abnormal returns. Hedge funds frequently leverage up to 10 times their total assets. John Paulson, a multi-billionaire hedge fund manager, has leveraged leverage to make authorized investors into multi-millionaires. However, if the fund manager's investment thesis is incorrect, the hedge fund may go out of business and all investors' money will be lost. Hedge funds that needed bailouts, such as long-term capital management, LTCM, were leveraged up to 30 times their assets. Number 7. Short-term investing. Have you ever seen a financial program on TV and been told that now is the time to short the market? Short selling is a common strategy to wager against a security by borrowing shares from an investor and selling them in the hopes of a price drop. Short sellers have made a fortune by correctly timing stock price falls. Short selling has the disadvantage of having no limit on losses, which means that short sellers can lose much more than their initial investment. Number 6. Trading in the foreign exchange market. With a modest amount of money, investors can control vast blocks of currencies through forex trading. Currency traders can have a 100-to-1 leverage on their accounts. Currency trading has the advantage of allowing you to swiftly change a little bit of money into a large sum. George Soros is regarded as the guy who ruined the Bank of England, having made a fortune of $1 billion by betting against the pound. Currency trading, on the other hand, has the potential to wipe out a trader's account in a matter of minutes. The larger international banks are the main players in this industry. With the exception of weekends, financial centers throughout the world serve as anchors for trading amongst a diverse spectrum of buyers and sellers around the clock. Because currencies are usually traded in pairs, the foreign exchange market establishes a currency's relative value by determining the market price of one currency when purchased with another. Number 4. Debt recycling. Debt recycling is a strategy for building wealth over time by transforming inefficient debt that doesn't generate capital growth or income, or isn't tax deductible, into debt that is more efficient, generates capital growth or income, or is tax deductible. One approach to achieve this is to pay off your unproductive debt with a lump sum, perhaps from a bonus or an inheritance. If you borrow the same amount and invest it, you're essentially replacing ineffective debt with tax-deductible debt that has the potential to build wealth. The following are some of the most important advantages of debt recycling. Save money on taxes. This method converts non-deductible debt, such as home loan repayments on a family home, into debt with tax advantages, i.e. the interest on an investment loan. Exposure to growth assets. Debt recycling might provide you with access to assets that you might not have been able to afford otherwise. If all goes according to plan, you'll be able to earn a passive income from your investments. Number 3. Taking out a loan to invest. Borrowing to invest, e.g., in real estate or stocks, also known as gearing, can be a powerful way to increase wealth over time by allowing you to buy more investments than you might otherwise. After interest and other costs associated with the debt have been factored in, gearing can offer a higher overall return if your investments improve in value over time. The asset's capital growth and revenue can also be used to repay the debt, plus interest and fees. The interest paid on the debt may be tax deductible as well. Number 2. Consolidation of debt. The act of taking out a new loan to pay off other liabilities and consumer debts is known as debt consolidation. Multiple debts are consolidated into a single, larger liability, such as a loan, with more favorable repayment terms, such as a reduced interest rate, a lower monthly payment, or both. Student loan debt, credit card debt, and other liabilities can all be addressed with debt consolidation. Debt consolidation is the process of paying off other debts and liabilities with multiple types of funding. You can apply for a loan to consolidate your obligations into a single liability and pay them off if you have multiple types of debt. Payments are made on the new debt until it is completely paid off. As a first step, most consumers apply for a debt consolidation loan through their bank, credit union, or credit card provider. It's an excellent place to start, especially if you have a solid relationship with your bank and a good payment history with them. If you're turned down, look into private mortgage lenders or companies. In terms of interest and fees, servicing several loans is very certainly costing you far more than you need to be paying. Increase your mortgage and utilize the extra income to pay off other, inefficient bad debt, such as credit card balances and personal loans, for example. Your house loan payments may remain the same, but you'll be paying off higher interest debt with its lower interest rate. Number 1. Increasing the efficiency of your savings. Many people choose to retain money in a cash savings bank account as a buffer or emergency reserve. This helps them feel more safe. In reality, this money would be better spent in a offset account tied to your mortgage. You'll receive a larger after-tax return while also shortening the term of your mortgage, all without putting any money down. All businesses are affected by energy and resources, which can have a significant impact on operations in terms of cost and productivity. Increasing efficiency in these areas has major environmental benefits in addition to greater competitiveness. You can create your resource efficiency strategy in one of two ways. Consume less, reduce the amount of paper and ink you use. Manage your waste. Make the most of the rubbish you produce by selling or recycling it. What do you think of our video? Let me know in the comment section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.